Time for business now here on France 24. He's back in the studio with us today, our business aficionado, Brian Quinn. And he's starting with the latest monetary policy decision from the US Federal Reserve. Brian.
Stuart, a decision with a mild flavor, but a spicy aroma, you might say. America's central bank wrapped up its two-day policy meeting late on Wednesday. As expected, the Fed held its interest rates steady at their current level of 5 to 5.25%. After 10 consecutive hikes, Wednesday marked the bank's first rate pause since 2022. Analysts, though, calling it a hawkish pause, as Fed Chief Jerome Powell signaled at least 2 more rate hikes to come later this year in a bid to cool stubborn U.S. inflation. A new data Tuesday showed inflation cooling, with consumer prices up an annual 4% for the month of May. Compare that with 4.9% the previous month. Core inflation, though, which excludes volatile food and energy costs, remained at 5.3%. That's, of course, well above the Fed's 2% target. Officials concerned that another rate hike this month could have damaged fragile U.S. economic growth.
Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain.
Well, to China next, where the latest economic data is presenting some stark challenges for the government. All major data points missing expectations as growth slows there. Retail sales were up just 12.7% on the year in May, well below April's 18.4%. Industrial production up 3.5%. That's a significant drop from April's 5.6%. Property investment, meanwhile, falling 21.5%, its fastest pace since 2001, as the People's Bank of China moves to cut interest rates in a bid to prop up demand. Most troubling, though, youth unemployment hit a record high of 20.8%. Beijing acknowledging the problem as its recovery from COVID restrictions weakens.
Current employment and structural problems cannot be ignored. Youth employment pressures are still high. There is a shortage of high-skilled personnel with difficulties both finding jobs and recruiting workers. We need a balance between employment supply and demand.
Let's get a check on the day's trading action now. Major Asian indexes mixed on Thursday in the wake of that rate pause from the U.S. Fed. Chinese indexes trending higher on those rate cuts from the central bank. Hong Kong's Hang Seng up nearly 1.75%. Tokyo and Seoul, though, in the red as we near the end of the trading day. Here in Europe, markets losing ground at the open as investors look ahead to the European Central Bank's latest policy decision due out later this afternoon. The ECB all but certain to hike interest rates by 0.25% as Eurozone inflation remains stubbornly high at 6.1%. The CAC 40 here in Paris down just under 0.33%. Next, Google is facing fresh antitrust charges here in Europe. The EU's competition watchdog says the tech giant's dominance in online ad services harms the interests of both advertisers and users, and that the only remedy is for Google to sell off major parts of its top money-making business. Jean-Emile Jamin reports.
It's a decision that could have Google bosses scrambling. 2 years after launching an investigation, European Union regulators have laid out charges against the tech giant of anti-competitive practices, threatening to break up its digital ad business.
We are concerned that Google may have illegally distorted competition in the online advertising industry, also known as ad tech. Should the Commission conclude that Google acted in an illegal manner, it might require Google to divest part of its services.
Being forced to sell off parts of its ad tech business would represent a significant blow to Google. It's the company's biggest moneymaker, with advertising technology bringing in 79% of total revenue last year. Under a 2022 EU law aimed at reining in big tech, Google could also be fined up to 10% of its global revenue. The Alphabet subsidiary has hit back at the latest antitrust charges.
The Commission's investigation focuses on a narrow aspect of our advertising business and is not new. We disagree with the EC's view.
It's not the first dispute between Brussels and the Silicon Valley giant. Back in 2018, Google was hit with a fine of over 4 billion euros when it abused its position by using Android to promote its own search engine. The EU has also previously ordered Google to pay compensation to print media for use of their content, while billions more have been slapped on the firm for abusive practices in online shopping and online advertising.
And finally, here on the Business Report, we focus quite a bit on inflation and its causes, from supply chain disruptions to fiscal overstimulus to corporate greed. Well, some Nordic economists have a new theory to explain persistent inflation there. It's Beyonce. The superstar singer's Renaissance tour blew through Stockholm with 2 sold-out dates in May. 46,000 attendees each night, many visiting from other countries. That demand sent hotel prices surging in the Swedish capital and well outside of it, with hospitality price hikes adding 0.5% to May's 8.2% inflation figure. Now, high inflation is squeezing budgets across Sweden, but Stuart, for those who got to see the show, that extra 0.5%, no doubt well worth it.
Yes, I wonder if other governments will start using that as a reason. Why have you got inflation?
Policy pickle, we call it.
Beyonce. Thanks, Brian. Brian, from Business on France 24.